Healthcare Global Enterprises Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Now, I hand over the conference to Dr. B.S. Ajay Kumar, Executive Chairman of Healthcare Global Enterprises Limited. Thank you, and over to you, sir.
Thank you very much, and good morning and warm welcome to all present on the Q4 and FY25 earnings conference for Healthcare Global Enterprise. Today, I'm joined by our CEO, Mr. Raj Gore, Ruby Vitolia, our CFO, and senior management team, along with our SGA, our investor relations advisors. We have concluded another year, good performance, and very meaningful progress. Also, as you know, there's an exciting year for us with new investors coming. As we have already announced, we have CVC is diluting place, KKR is coming in, formalities are being completed. We look with the new investors for a long-term vision for HCG, which is very, very important to us. HCG continues to be the leader in cancer care, quality of care outcome, standing as the only major healthcare institution with truly pan-India presence. Over the past year, we have strengthened this position by upgrading our infrastructure significantly across and also done some M&A, details of which you will hear later on. Over the past 2 decades, we have championed a distinctive integrated model that combines multidisciplinary clinical expertise with over nearly 350 to 400 doctors, advanced molecular and genetic diagnosis, supported by robust hub-and-spoke model network. This comprehensive approach enables superior clinical outcomes powered by skilled clinicians, cutting-edge technology, and most important, data-driven decision-making in real time. In the past, we used to say, bedside to bench, and then a patient would get the necessary, next patient would get. But today, I'm very happy to report, we are pioneered in bedside to bench and bench to bedside, so the patients get the right treatment at the right time, very first time. Looking ahead, we are making focused investments in next generation capabilities, especially in early cancer detection and precision medicine. The most important part in any cancer treatment is proper staging, diagnosis, and the right treatment for the patient at the right time so that the failures will become less. In line with our commitment to cutting-edge diagnosis and research, we are pleased to share that we are acquiring the Orbitrap Astral mass spectroscopy from Thermo Fisher Scientific, one of the most advanced platforms globally for high-resolution mass spectroscopy. In this regard, I'm also happy to rate this advanced equipment is now first time being released, and we are one of the first acquirers of this in the world. We are very proud. We have put together a solid team to see how we can go into the depth of cancer management and also acquire the necessary data for future research and development. It will enhance our molecular and proteomic profiling capabilities. So we are going from genetics to proteogenomics, enabling our precise disease characterization and paving the way for next generation biomarker discovery, targeted therapies, and repository in terms of old drugs in new bottles. Our long-term commitment is to our patients, building a strong academic and research foundation. Through our fellowship programs, which is expanding rapidly, and clinical research initiatives, we are nurturing the next generation of oncology leaders. Support. Together, we are shifting the narrative around cancer from fear to confidence, from complexity to clarity, from inequality to including access for all, so we can make cancer a lifestyle disease and people with cancer can have a good quality of life for long term. I would like now to hand over the call to Mr. Raj Gore, our CEO, who will provide insights into our strategies moving forward and share the operational performance of the quarter and the year. Raj, handing over to you.
Thank you, Dr. Ajay. Good morning. A very warm welcome to all the participants on the call. We are proud to report a strong operational and financial performance this year. Excluding our Milan centers, the company's revenues grew by 20% in the quarter and 17% for the full year, reaching 571.1 crores for Q4 and 2,165.1 crores for FY25. Our adjusted EBITDA for the quarter was 106.9 crores, up 14% with margin of 18.3%, while for the full year it stood at 396.3 crores, a 17% increase with margin of 17.8%. This strong performance reflects the strength of our business model, brand, and the expertise of our clinical teams and the efficiency of our advanced technology centers. Before we dive into our operational highlights, I would like to take a moment to reflect on how cancer care in India is evolving and how HCG is playing a pivotal role in driving that transformation. Cancer care in our country continues to face deep-rooted challenges, particularly when it comes to early detection, awareness, and equitable access to quality treatment. Even today, far too many cases go unnoticed until they reach an advanced stage, especially in Tier 2 and Tier 3 cities, where awareness levels and diagnostic infrastructure are still evolving. At HCG, we have taken this challenge head-on. Through focused awareness campaigns, screening initiatives, and active community outreach, we are educating people about the importance of early diagnosis and preventive care. But awareness alone is not enough. We are backing it with action and infrastructure. We have made strategic investment in some of the most advanced technologies in the world: linear accelerator machines, PET-CT scanners, robotic surgery platforms, bringing precision, personalization, and world-class cancer treatment even to smaller cities across India. So patients don't have to travel long distances or face delays in getting the care they need. This integrated approach, combining education, access, and innovation, is already making a real difference. We are seeing more patients come in earlier, we are delivering better outcomes, and we are improving quality of life across communities. Let me now walk you through some of the key operational highlights of FY25 that are shaping HCG's performance and positioning us for continued leadership in the cancer care space. First, our expansion in Vizag through the addition of MG Hospital marks a significant milestone. With this acquisition, we have further consolidated our presence in the region and strengthened our position as the #1 oncology care provider in the region. Second, during the year, we added 5 state-of-the-art linear accelerator machines across multiple centers. LINAC machines are capital-intensive but essential for delivering precision radiation therapy. Our innovative pay-per-use model has allowed us to remain asset-light while still offering world-class treatment. I'm happy to share that these machines are seeing rising utilization rates, indicating both growing demand and increased trust in our clinical capabilities. Our emerging centers have also shown strong performance, and we are beginning to see the results of the groundwork laid over the past few years. Our South Mumbai center, which was previously impacted by drop in international patient flow, has made a remarkable comeback. We recorded year-on-year growth of 37% for the quarter ending 31st March 25. Meanwhile, our Kolkata center delivered a robust 22% growth, fueled by increasing local awareness, improved clinical offerings, and better operational alignment. Both centers are now well positioned to contribute meaningfully to our overall performance. We remain confident in the long-term potential of these emerging hospitals. As they continue to mature, we expect them to enhance our margin profile, especially as operating leverage begins to set in. On the digital front, we are seeing encouraging results. Digital revenue for FY25 has doubled over the past year, and we are committed to scaling this further. We launched our official HCG mobile app, a platform that enables to book appointments, consult doctor virtually, access reports, and manage their care journey end to end. The response has been very positive. As we continue to digitize our patient experience, we expect digital revenues to become a major growing contributor to our top line in the coming years. Looking ahead at FY26, we have started the year on a strong note with the formal inauguration of our flagship HCG Cancer Center in Ahmedabad, a 189-bedded state-of-the-art facility that marks a significant milestone in our expansion journey. This new center is designed to deliver comprehensive oncology care at scale, featuring 9 OPs, 34 ICU beds, 22 daycare beds, 6 dedicated bone marrow transplant units. This strategic capacity enhancement positions us to handle a projected 30 to 40% increase in patient footfall at this center. Additionally, as a part of our continued efforts to deepen our leadership in key markets, we will commence operations of 2 new hospitals in Bangalore. The first unit is North Bangalore, a fast-growing urban cluster with rising demand for quality cancer care, will come in second half of FY26. This facility will help us tap into new catchment area while expanding access for patients in the northern corridor of the city. The second facility will be in Whitefield. It is a strategic extension of our existing Center of Excellence in Bangalore. This expansion will act as an arm to our flagship unit, enhance patient experience, and deliver specialized services with greater operational efficiency. As informed earlier, we aim to expand in our existing markets by operationalizing over 900 beds across networks within next 3 years, including this year's addition and 350 beds that are fully invested but not yet operational. Backed by a strong clinical backbone, a patient-first approach, and a future-ready mindset, we are not just building hospitals, we are shaping a more hopeful, accessible, and technologically advanced future for cancer care. With this, I hand over to Ms. Ruby, our CFO, for financial highlights.
Thank you, Raj, and good morning to everyone. As Raj mentioned, we've carried the momentum from previous quarter into the close of financial year 2025, and I am pleased to report another strong performance that underscores both the resilience and scalability of our business model. For the quarter ended 31st March 2025, we recorded a robust 18% year-on-year growth in revenue, reaching INR 585 crores. And on a full-year basis, revenue grew 16% to INR 2,223 crores, reflecting consistent execution and growing trust in our network. Our core HCG centers, excluding Milan, was the primary driver of this growth, delivering a 20% increase in revenue, accompanied by 17% growth in EBITDA, resulting in healthy EBITDA margin of 18.5%. Revenue for HCG oncology specialty centers, excluding new acquired MGM, grew by strong 16% and EBITDA at 17% YOY, and EBITDA margin was at par with Q4 of FY24 at 19.7%. We believe these achievements place us firmly ahead of industry averages, and we are optimistic about delivering even stronger growth in FY26 both in terms of revenue and profitability. A few key operational metrics further reinforces this momentum. Outpatient footfall rose by 13.8%, indicating higher patient engagement. In medical oncology, we saw a 24% growth in chemotherapy sessions, a clear indicator of growing patient demand. Our LINAC machine utilization remained steady at 60% in Q4 of FY25, despite addition of 3 new LINAC machines and acquisition of 2 LINACs with MGM Hospital over the last 12 months. Bed occupancy stood at 54% in Q4, slightly down from 56% in the previous year, driven by capacity increase of 235 new beds. This short-term dip is well within expectations and aligned with our long-term growth strategy. Turning to the performance of our centers, for the quarter ended March 31, 2025, our established centers continued their steady upward trajectory with a 22% increase in revenue and 15% growth in EBITDA. Our emerging centers outperformed expectation with 32% revenue growth and a remarkable 44% increase in EBITDA, clearly reflecting the operating leverage at play as these centers scale. Strong growth in our emerging center is a testament that these locations are not just growth drivers, but key strategic hubs in Tier 1 cities and access to large domestic and international patient base. Their sustained recovery and performance will be instrumental in strengthening our margin profile going forward. On the pricing and efficiency front, for the quarter ended 31st March 25, ARPOB across our network increased by 4%, reaching to 44,236. Established center recorded an ARPOB of 42,595, growing by 2.5%, while emerging centers delivered an impressive ARPOB of 66,755, growing by 12.5%. Looking ahead, we plan a capex of 286 crores in FY26 in line with our network expansion and technology upgrade plans. Our effective tax rate for the quarter stood at 50.3% and for the year at 14.3%. We remain focused on improving efficiency while maintaining compliance and governance standards. Our PAT for the quarter was 7 crores and for the year was 44 crores. As we communicated during the year, we added 2 new centers. The HCC new facility was operationalized and we acquired the new MG center in Vizag. Our expansion efforts led to ROU creation of 275 crores, fixed assets addition of 400 crores, and an increase in net debt of about 250 crores. This together led to an increase in depreciation and interest together of about 25 crores. With scale-up of our expansion efforts both in HCC and completion of our integration in Vizag Center, we expect a higher return on these investments going forward. Before I take questions, I request Dr. Ajay to add anything further.
Thank you, Ruby. I just want to say Ruby has explained the rationale for our numbers, including the PAT. But in this regard, as we know, in the last 4 years, we have been in a consolidation mode. We have taken a call to expand with merger acquisition and including what Raj Gore mentioned about the greenfield centers. All of this, I believe, particularly with the new partner coming, KKR, who will be solid foundation for future long-term growth of HCG. So the measures we have taken now are all very much in line with the long-term growth of HCG, and we really want to be in a dominant position to provide quality cancer care across India. So with this, I would like to conclude and I will hand over to the moderator people. Thank you very much. And one other addition I want to add before you take is regarding the debt issue. We have communicated to the investors in the past that once the new investors, shareholders come, we will be looking at the possibility of equity, primary equity coming into the system. And this will be decided in the coming few months. Thank you very much.
We can now take questions from the participants.
Sure, ma'am. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Gautam Rajesh from Everflow Partners. Please go ahead.
Hi, good morning. Am I audible? Hello, am I audible?
Yeah, good morning. Yeah.
Good morning. Yes, sir. I had two major questions on the margins only. Our margins are much lower than the other hospital chains. Is that going to be a steady margin profile for our type of single specialty based healthcare? And my second question was, what sort of margin profile do you then expect at a company level for the coming year and maybe the next 3 years?
Hi, this is Ashutosh.
Yeah.
The margins, if I can draw your attention to the slide number where we have showcased our established and slide number 29, which has showcased our established and emerging centers. You would notice that we have over 20% margin in our established centers, showcasing the strength of the platform. However, our emerging centers are a little over 10%. Together, we are delivering close to about 18% margin. As our emerging centers continue to grow, which is again reflected in last year's performance, you will see that our revenue grew by 32% and our EBITDA has grown by 44% in the same quarter for emerging centers, reflecting a growth of EBITDA, reflecting an increase in EBITDA margin as well. As they inch closer towards the EBITDA margin of the established centers, we expect our EBITDA margins to improve going forward. Now, with respect to the current quarter's margin, we have seen slight decrease of almost about 40-50 basis points in the EBITDA margin corresponding to same quarter last year. That is primarily because we have experienced higher medical oncology business, which is reflected in our chemotherapy share. You would see in slide number 30 that our chemotherapy volumes have grown by 24%, which is far superior than other modality. I would like to just inform the participants here that while we look at comprehensive cancer care and all the modalities are equally important for us, however, from financial outcome perspective, medical oncology, while though it is least profitable, but highly return accretive. So the way we see it is, as the medical oncology also grows, it may have some pressure on our gross margin, but as we go along, we will have a higher operating leverage, returning and eventually leading to better returns.
Okay, sir. So like over the next 3 years, do we see it improvement? Like, is there like a particular number or like you can quantify it by any form of how much improvement can be seen as the emerging centers also catch up in margins?
So all put together, from our current portfolio, excluding the expansion path we have taken in terms of we are opening up new centers. From the current portfolio, we should be expecting more than 20% in the future to come, in the near future. I mean, when I say near future, as you mentioned, about 2 years' time.
And I just want to add, Ashutosh, I just want to add there that please, they have to keep in mind some of the new centers in Bangalore which may come that can also have a stance on the margin. But is it, I think it is good to say as the emerging centers also rack up, our margin, as we always indicated, will be in the low 20s. That is our initial goal.
Understood, sir. The low 20s would be initial goal. Understood. Thank you, sir. That will be some.
Thank you. Ladies and gentlemen, to ask a question, please press star and one. I repeat, participants who wish to ask questions may please press star and one at this time. We take the next question from the line of Yash Sinha from MIPL Family Office. Please go ahead.
Hi, am I audible? Hello?
Yeah.
Yeah, hi. I just wanted to understand what our strategy was in terms of translating a lot of the revenue growth and EBITDA growth that we've had over the past 2 or 3 years into tangible PAT growth going forward. What are the specific strategies that we are incorporating in order to do that, in terms of maybe using the primary issuance to pay down some debt so that we can see some PAT generation going forward?
So, as Ruby and Dr. Ajay also indicated in their speech, that right now we have taken up a lot of investment initiatives, including organic and inorganic growth. We may see a little bit of pressure on PAT. Our goal is to optimize EBITDA, focus on the growth of EBITDA, grow revenues. I think if it all be one has to look at our PAT from the existing portfolio, we expect a healthy growth, which may see some dilution happening from our new investments in the near future. But as this EBITDA of the new investments continues to grow, maybe in a year's time or maybe after 1 year, we should see a healthy growth in PAT as well.
Got it. And this primary issue that we spoke about.
Ashutosh, you want to comment on the interest-related PAT effect, how will it get improved with possibility of primary coming in?
Yeah. So sorry, Doctor, and thanks for adding this up. Now, as we have, including the capex we have done in the last year, a lot of it is got funded through debt, which has resulted into higher interest costs and corresponding depreciation because of the asset addition. However, as Dr. Ajay indicated, depending on the quantum of primary we infuse, it will substantially reduce our interest costs, which would help our PAT. While we are right now evaluating how much primary is sufficient for near and long term for the company at this point of time, once we announce, probably you would see the primary helping reducing our debt and would have corresponding effect on our interest.
Got it. Understood.
And also,
I think that's it from my end. Congratulations on another good set of numbers and all the best.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. To ask a question, please press star and 1 now. We take the next question from the line of Devang Patel from Samiksha Capital. Please go ahead.
Hi, sir. The first question was on receivables which are higher on a YOY basis. Could you throw some light on that?
Yeah. Hi, Devang. So the receivables, we had a little higher during the year. Last year, we saw a lot of state getting into elections, and there were code of conduct getting applied, because of which some of the collections actually spilled over to April. So in fact, April usually is the slowest in collection, but this year there was difference. March, we did a highest ever collection that we could do in March, and that continued in the month of April itself also. So now we will see a more streamlined one with a normal increase in our credit sales, which is happening.
And just if you can quantify this to be for you, it's like if you look at our cash flow statement, I think last year we had almost about 40-45 crores of working capital increase. Against that, about 80-85 crores current year.
Correct.
And the increment, the deficit of 40 crores probably we have made it up in the month of April.
In the month of April.
So there is not large gap from there. It's that timing issue which got spilled over to current quarter.
Will this be the new normal in terms of receivable days?
So as I said that the receivable days in the end of March was temporarily high. This already got corrected in April. So I wouldn't say that the March number is the new normal. In fact, in terms of number of days, if I have to say, 105 to 107 should be the new normal, which we will maintain. However, at the end of March, we were at somewhere around 115. So we have covered up around 7 to 8 days in the month of April.
Just one more point maybe. Is that we also acquired MGM Hospital in Vizag.
Yeah.
That incremental receivable has also come in our book.
Correct.
Okay. You explained at different points on the margins for the mature centers. Now, Vizag had 35% margin in the earlier year. Did that not pull up our margin for the mature centers? What was the impact of Vizag in revenues and profits in the second half or for the full year?
So, Vizag Well, I'll give you the exact numbers. Vizag, as Dr. Ajay indicated, that we are transitioning right now. We are integrating the facility at that place. During our evaluation, we had evaluated some of the costs not being sustainable in terms of doctor's costs and other streams of cost. That has been corrected, and we have brought them as per standards of HCG. That's point number one. Second is we have also experienced for Orissa government pulling out its government scheme from non-Orissa states, and Vizag in Andhra Pradesh had been the largest beneficiary of treating patients from Orissa under this scheme. That scheme has been now only consolidated for the state of Orissa and has been removed from other states. So that had little bit of impact on our Vizag center. That has resulted into a decrease of revenue per month, which is about 1.5 crore, almost 4.5 crore. That has suppressed our revenue and has had its impact on EBITDA. However, we have taken enough initiatives within the states. We have got a good leader at that place. Right now, we are looking at augmenting the business within the state and compensate for the losses which we had in Vizag center. Now, as far as revenue and EBITDA is concerned, I think you can just hold on. I'll just give you the number right away. Just a minute. MGM had a revenue of 50 crores in H2 with an EBITDA of 9.5 crores.
Sorry, can you repeat the revenue number?
50 crores.
This is a new
EBITDA of 9.5. Sorry?
What would be the normalized EBITDA margin for this center going forward?
Right now we are in rebuilding phase of the loss revenue from Vizag, from Orissa. However, as we make up that revenue, which we are hopeful to do it in next 2 quarters, then I think we should be operating somewhere close to about 25 to 30% margin.
Okay. My other question was on CapEx.
In the current quarter, we also had. Sorry, I'll just add to this. In the current quarter, we also had one-time impact of some cost which was identified during diligence. Those costs we have taken up to regularize some of the things which was not there, which has been done. So that had an impact of almost about 1.5 crores. So including that, our EBITDA should be in the range of about 11 crores.
Thank you. The other question was on CapEx. There are 2 centers on which CapEx is mentioned in the slides. Is there any other CapEx over and above these 2 centers for the next 2 years? And also, given we are looking at primary equity infusion, is that only to reduce debt, or we could look at further CapEx in the next 2 years after that?
So Ruby did indicate our current year's CapEx plan. I think it is in the range of about 20 to 80 crores. We already invested a little over 200 crores in last financial year. That includes close to about 100 crores of maintenance CapEx. And large growth CapEx within our existing centers and markets are in Bangalore and Cuttack. Outside of it, right now we have not much plans in terms of further growth CapEx. So this 286 crores in the current year should reduce going forward with maintenance CapEx of about 100 crores and some growth CapEx would come. We would keep the market appraised of our growth plans once we again sit together, draw a strategy for 3 to 5 years of the incremental CapEx if at all it comes. However, we have given visibility in terms of how much CapEx we would do in the current year, which is close to about 280 crores.
Okay. Sir, and lastly, on the resolution of the earlier PE investor giving bonuses directly to some of the employees, how many employees are covered, and what was the rationale for doing that? Was there an earlier agreement on that?
So I think all the relevant information have been disclosed at SEBI. There was no direct agreement between company and the investor, and I think for the company to comment on this would be a little difficult. So we would not comment.
Ashutosh, what is the question?
The question, Doctor, is that there were transaction bonus which were paid to the employees directly by the shareholders. What was the thought process behind it, and is there any other arrangement right now?
It is purely a thought process of CVC. They felt because of their exit, they should reward the bonus for some employees. And for this, there was an approval by the majority of the minority shareholders. So any questions they have on this regard, I would direct them to talk to CVC because we are not in a position to comment.
Sure, sir. That's all from my side. Thank you so much.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. Next question is from the line of Aditya Chheda from InCred Asset Management. Please go ahead.
Good morning. So you mentioned that, if I got it right in the initial comments, there were 900 beds additional over next 3 years, and 650 are invested but not yet operational. Can you explain that better? Because there is a slide 32 which says 85% of capacity beds are operational. So if you can explain more on that, it would be helpful to know your plans going forward.
So Aditya, of the current capacity, I think we have almost about 150 to 200 beds which are still not operational. In addition to that, we'll be investing in the remaining 700 to 800 beds. Almost about 200 beds have been invested already, and the further investment on 700 beds have to happen for the guidance of about 900 to 1,000 beds in next 2 years.
Got it. And the next question was in terms of cluster growth with the new Ahmedabad facility and facilities in Bangalore. Karnataka and Gujarat would be the ones which are expected to drive growth in the near term. Is it a right inference that these are higher ARPOB clusters versus the company average for us as of now?
Yes. That's absolutely right. That's absolutely right. So if you look at it, wherever we have, whichever region we have presence in metros and tier 1 cities, there we have ARPOB, which is almost close to about 2 times of what we generally have in tier 2 cities. So these centers is where, obviously Ahmedabad and Bangalore, they would contribute. In addition to that, we also expect the higher ARPOB to come from Calcutta and Mumbai centers. So if you look at our slide, emerging centers, which is primarily 2 centers in Mumbai and 1 center in Calcutta, is delivering over 60,000 rupees per bed compared to overall of 45,000.
Got it. So this should calculate into a high single-digit ARPOB growth for us directionally?
Yeah, that's right.
Got it, sir. Thank you. That's it from me.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 at this time. I repeat, participants who wish to ask questions may please press star and 1 at this time. We take the next question from the line of Kashish Thakur from Elara Capital. Please go ahead.
Hi, thank you for the opportunity. So 2-3 questions from my end. So first question will be on the revenue which we generate from the digital channel. So can you just shed some light that how it is and how we are planning to grow it, and first will be around that part.
Yeah. So thank you for that question. Just to give a little bit of background, there are about 2 million new cancer patients every year in India in a population base of 140 crores. This is a widely spread, thinly dense and fragmented customer base. One way of looking at it is a traditional way to reach out to them through traditional approaches of advertising, reaching out, camps, etc. But because it's such a widely spread segment, there are limitations on physical outreach. But we know that, consumer in every sector, patients want more information, want more power over their, patient journeys, want to have more say in the decision making, and they are using digital mediums to get informed, find information, and to reach the right care provider. So basically what digital platform gives us is the ability to make patients easier to find us rather than we trying to find these 2 million patients among 140 crore population. Now, we try to reach out to them through different digital channels, website, patient app, social media handles. There are some third-party channels. Our majority of revenue comes from our website and our social media handles. The way to drive it is search engine optimization, market after market, local. I think in last year we have doubled our revenue. We are still working on making our search engine optimization better at each geographic location. As that journey moves forward, we will be ranked higher in potential patient searches, and therefore it gets us into their consideration set right away. And that, we have seen from our experience, as long as we are in their consideration set, our ability to convert them into a purchase decision or make them walk into our doctor's consultation room, that conversion ratio historically has been very high for us because of our brand and clinical capabilities, etc. And as you know, among healthcare, if there is any specialty where patients do not mind travel long distance to any corner of India or the world, it is cancer, because it is a life and death. So we feel that as we invest our efforts, energy, resources in digital, we will be able to reach out to more and more diagnosed cancer patients across the country and even outside the country in our international markets. And this is a channel that will continue to grow for us going forward, contributing more and more revenue to our top line.
Thank you for such a beautiful explanation. The next question will be on the tax rate. What kind of tax rate should we expect for FY26?
Come again?
Can you repeat the question, please?
I was asking about the tax rate, ETR. What kind of effective tax rate should we expect for FY26?
I think we can expect about 30% to remain in that levels during the next 1 year.
Understood. Just wanted a clarity, what kind of competition are you seeing in oncology space, as many of your multi-specialty competitors have been aggressively taking step in this direction. So how do you see the competition, especially in the markets outside Bangalore?
So
Go ahead, Dr. Ashish.
See, as we know, we are a focused specialty. We believe we have continued to garner higher share of market in a city like Bangalore, Greater Bangalore. We are known as a destination. So in our view, our growth, as you can see in our Bangalore sector, which is doing extraordinarily well. If you look at our main center of excellence in Bangalore, the growth, the margins have been extraordinary, generating a margin close to 28-30% with ARPOB over 75,000-80,000. So this kind of high quality growth will continue to happen in spite of whatever the number of centers there may be. The reason I say that is oncology has to be a destination. It is not a disease of convenience. So in my view, a multi-speciality, this is my view, and that is how we started HCG as a single specialty. My view, a single specialty hospital always will deliver better quality and outcome overall. because of the way we have structured the ICU, the outcome, what we measure, the multiple support system we give for the patient specific, for example, infection. If you look at our mortality rate, let me give you one example. Across India, which I do audit our mortality recurrence rates, when you look at our mortality in 2017, for 5,500 discharges, we had a mortality of 2.5% per month across India. But today, when you look at after we got into this auditing, today our mortality for 13,000 discharges, 13,000 per month, is less than 9.9%, below 1%. Our target should be 1%. Now we are trying to even lower that. I don't think anybody in the world has this kind of low mortality. I can tell as an oncologist.
Understood, sir. Thank you.
People who...
Yeah, sir, please go ahead. I think so.
Yeah,
my line got... Yeah.
No, I just want to say, we measure it, we put out of our data and do all that. And we also do data collection for research academics. So when you talk about the competitive landscape, we feel, honestly, they should be worried about us, not worried about them. Because the way we are expanding, putting together the quality of excellence, the quality we have today is unmatched. And I trained in Houston, MD Anderson, I can say we are equal to that, very clearly. So this is where we are with genomics, proteomics coming. So I hope I answered your question.
Yes, sir. Yes, sir.
Dr. Ajay, I just want to add two data points. One is, let me give an example of Bangalore. There is no other place where there so many multi-specialty players are doing oncology, and they have multiple hospitals doing oncology in Bangalore, and yet we have grown our market share over the last 4 years. Number two, we entered in Kolkata and Mumbai market pretty late, and there were existing hospitals who were dominant player. But in both markets, we have gained largest market share over 4 years and climbed the market share ranking. And both are an example of why our single specialty focus, we feel is a better approach to specialize and focus and, build, confidence and trust of patients, because, this is the only thing that we do. We live, eat, breathe, drink oncology, and that gives us our best chance to give the most advanced and comprehensive treatment to our patients, and that's what is working for us till date.
And just one more data point, if I may add, in this regard. It's like all the centers or the states where we have been market leader, we have not lost our market leadership in last 3-4 years, in spite of competition coming in. The way we approach this and think about it is that India is an underserved market in terms of supply. And as the supply keeps growing, it's going to help the best player who provides the best quality in that space. Oncology is something which is a matter of life and death. And this is the only specialty among all other specialties in healthcare where second opinions are the highest. So once the patients are diagnosed that they have any indications of cancer, they try to figure out who are the best providers in that market to give them the best solution. So we have seen this helping us all across the market.
Ashutosh, one other thing is, it is not only like if a patient goes to a multi-speciality with abdominal pain and they found that they have a cancer, they may end up taking treatment there. But remember that significant number they have recurrence. When they get recurrence, that is when they come to HCG. That is why I called it a destination. So that is how MD Anderson is, and that is how we have positioned ourselves as a destination, and that is why we will continue to grow.
Understood, sir. Thank you so much for this. So just one last question. Why do we see our ARPOB still on the lower side? I still believe that oncology treatments are a bit on the expensive front. So why are ARPOBs are so low?
So, if I can take that question, Dr. Ajay. See, if you look at, we have significant presence in tier 2 cities, where we treat low strata of the population. However, we have also showcased, and you may refer to our investor presentation, we have come out with a business model where we look at similar profitability and return in those tier 2 markets in spite of ARPOB being lower. While the ARPOBs in metro cities are higher, we have a larger scale in terms of throughput and number of patients we treat in tier 2 cities to help us generate similar profitability and return even in tier 2 cities.
You may also want to make an observation, Shutosh, on how our ARPOB is in our centers in urban areas and why the tier 2 are maybe why it's lower and it is expected to be lower. So maybe you can make a comment on what is our ARPOB in urban.
Sure. So in a center where we have full offering in terms of high-end therapies as well as being in metro, like for example Bangalore and Ahmedabad, they clock close to 1 lakh ARPOB per patient. Then comes Mumbai and Kolkata, which ranges in the range of about 70 to 80,000 in Mumbai and Calcutta. So these are the markets we have very high ARPOB. The other markets where we are in the tier 2 cities, which is Orissa, Andhra, these are the places we have less than 35,000 of ARPOB, overall resulting into 45,000 ARPOB for the company. But again, it has been steadily increasing. That's right.
Understood, sir. So just one last question. So I might have missed what kind of ARPOB growth we might expect in FY26?
So in last 4 years, I mean, coupled with the change in modality, reduction of ALOS, less and less number of beds being required, and the price increase we take, I think we have been seeing 7 to 8% increase in ARPOB, which we expect to continue.
Understood, sir. Thank you so much. Thank you, sir.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. To ask a question, please press star and 1 now. Next question is from the line of Sakshi Pratap from Pratap Securities. Please go ahead.
Hi, thanks for the opportunity. Just a couple of questions. So how was the performance overall for international patients? How do you think we've fared this year compared to last year, given this year had a lot of geopolitical issues?
Yeah, so Sakshi, the biggest contributor to India, not just for HCG, but for all hospital players in terms of international business, is Bangladesh. And as you know, because of geopolitical issues between our two countries, India has reduced drastically the number of medical visas that India grants to Bangladeshi patients. That is a major reason for the impact on international business across India, across players. That to some level has improved, but I think that will continue to be suppressed for next few months till our relationship between two countries get completely normalized. So that's the outlook in general for India. However, as you know, even though our international business got impacted last year, we have more than made up for it through domestic channels. So, international for us is a small part of our total business. Our core is domestic, and we will continue to monitor, international business situation. However, we will continue to work on, making up for any reduced growth on international through domestic channel, like last year, even this year. So we don't expect it to impact our revenue growth this year.
I just want to add one more word to what Raj said. When we look at international, as we know, CCK Cancer Center, which is into radiation and medical oncology. I'm very happy to say that this center has been doing very good. We have installed a new radiation equipment, PET scan, and we are now in the process of possibly looking at a second LINAC in Nairobi. And we have also discussed at our board a concept note to see how we can really further improve there. Because international opportunity in countries like Africa are significant. And what we have shown is a significant growth, high profitability there, with the margin reaching almost 24-25%. So this is one other angle which we will be addressing in the next few quarters with our new investor, and we will keep you definitely updated on that.
Understood. And would you be able to provide the percentage contribution by international patients to our revenue?
Around 4% of revenue is from international.
Okay. All right. Yeah. Thank you so much.
Thank you. Next question is from the line of Umang Gada from Avenor Capital. Please go ahead.
Hi, thank you for the opportunity. My question was more on the Milan side of the business. That business has evidently continued to struggle to grow. So I just wanted an update from the management side that what are the strategies over there?
Yeah.
Or even maybe are we looking to spin off in the future or any strategies over there?
Yeah, I can answer that. You are absolutely right. Milan have been through quite a tough time, and particularly with our former partner, herself starting units near our center. We have addressed this issue internally. We were just waiting for the new investor also to come. We have also discussed with them. So we are definitely putting a proposal to divest Milan. And hopefully this will happen definitely this fiscal year, and we'll keep you updated.
Management team, I'm so sorry to interrupt.
Were you able to hear my answer? There was some background noise. Can they hear the noise? My answer?
Yeah, I was